morning and happy Friday to you. It's November 30th and we are cheering on Memphis and the BSU Broncos. So last week we had rates improved quite dramatically actually. The Federal Reserve came out in his testimony to Congress on Thursday and Wednesday and basically said that they want neutral rates at 3%. Currently we are at 2.5%. So the Federal Reserve is going to raise their rate this month, guaranteed about 0.25%. That puts rates at 2.5%, and for the Fed fund rate. And then if the Fed wants 3%, that means they're only going to raise rates twice next year. And this was kind of a gulp for everybody because they anticipated the rates would go up 3 times next year, and that there was really no cap for the Fed. So that means the Fed could have raised rates to 3.5% to 4% or 5%, which would have had a negative effect on mortgage rates. So this was a really great show by the Federal Reserve that, hey, maybe we're going to slow this down a little bit, and it's probably going to help out interest rates. It definitely did this week. A couple other things this week that we saw is the unemployment numbers. We saw unemployment spike as we thought we would, but hopefully we're not going to see a trend. And then also this coming week is all about unemployment numbers again. So we have ADP private payroll coming out on Wednesday. And then on Friday, we have the big one that comes out, the Bureau of Labor Statistics, the overall unemployment in the United States. This number really isn't going to affect rates too much. What's really going to affect rates is wages and income. If we continue to see wages and income spike and go up, this is negative because this shows inflation, and inflation is bad for mortgage rates. So let's take a look at the charts for this last week. We actually saw interest rates go up pretty nice this week. I'm sorry, up is bad. Up is good for us. Down is bad. Green's good. So here is the Federal Reserve talking, and the rates were actually worsened that day. And then after he talked, it spiked all the way up and broke this 50-day moving average. Then the next day it continued to break it. We've got a little bit of settling over the last 2 days, but you can see we definitely broke out of that 5 1/8 mark into this 4.875, maybe even starting to tick up to the 4.75 for conventional rates. But what's really nice is we're starting to see a nice little floor of support right here, which is going to help rates stay this way. So we are actually going to be in a floating mode right now on interest rates. There's really not too much to cause the rates to sag back down, which would be negative for rates. One other thing that I mentioned was jobless. Originally we saw jobless at 214. This was 216 originally, and it got revised up. Last week was a holiday week, so it's 224, and then this week we saw a 234 for unemployment filings. As this number gets closer and closer to 300, which we hope it doesn't, that would be negative for interest rates, which is going to start showing higher unemployment numbers. So we're anticipating a little bit of a blip due to fires in California, but we'll kind of have to see what's going to happen over the next coming weeks. So right now we're looking to cautiously float for rates. A couple pretty good reports that came out this week that's showing trends in real estate. First one is the Federal Housing and Finance Association report. This is showing that home prices are going up 0.2% month over month and 6% year over year, showing that the Pacific Northwest is slowing down a little bit. And then the same day, the Case-Shiller price index came out. This is a 20-city index showing month over month up 3 basis points and year over year up 5.1%. This one breaks it down a little bit more to cities, and you can kind of see like Portland, San Diego, and San Francisco and Seattle all are either flat, which is San Francisco, or showing some negative trending. These numbers, along with a couple others, go into a real estate report card. Here's the real estate report card for 80 County for this month, and I'll try to post these every month from now on, so the link will be down below. But you can see the average medium home price is $291,230. Based off of the statistical data, the historical and the forecasted appreciation rates are here, and then you can kind of see where those historical appreciation rates are going over the next 5 years. And we are seeing a little bit of plateauing prediction going on. This is also a pretty good report, shows how many renters are available and how many renters can potentially purchase. Say that 3 times. And then it also shows some affordability. Affordability index is kind of an interesting one. We watch this one because the closer it gets to 100, the more affordable homes are in the area. This is the Ada County one. And if we switch over to Canyon County, we can see the median home price here of $188,750, the forecasts, the 5-year gain, and then the affordability index. So a couple good reports. Use these for social media posts. Use these for helping people get off the fence. They're all pretty nice reports. The government also this week updated conforming loan limits. So every year they will tell us how much we can do maximum mortgage for conventional financing and VA financing. And those came out this week. You can kind of see, I've updated the website, but for like Ada County and most of Idaho, the conforming loan limits are $484,350. If you get into some of the higher price counties like Blaine County here, it's going up to $726,525. So that's the maximum loan limits we can do without going to a jumbo loan or to a different loan product. So if you ever need information, you can always go to my website and go to resources and conforming limits, and you can just click whatever county you want and it'll tell you what the loan limits are. We anticipate in the next week FHA will release their loan limits for 2019. That way we can get all 19 locked up and see how much we can do loans for. And finally this week, my marketing tip is Christmas cards. It is time to get your Christmas cards out. We have all of our Christmas cards in, and we're going to get those out in the next week or so. It's super important that you keep in contact with your past clients. They are the people that are going to refer you the most business. You can spend thousands and thousands of dollars on grabbing leads, but you got to remember, once you have that lead, you need to keep that lead for life. And if you are not keeping that lead for life, somebody over the internet or somebody on a mailing is going to do it for you. So wish your past clients a very Merry Christmas and send them out a Christmas card. Give First Choice Mortgage a call today and let us show you how easy, simple, fast, and professional mortgage lending can be.